All right, Martin, as we're setting up, I want to thank you for joining us on In the Money with Amber Kanwar. And thank you for taking a break from Twitter to be here. You're so prolific.
It's a great place to collaborate, share ideas, and obviously try and contain yourself from telling people how you really feel.
That's you contained on Twitter?
Well, no. Oh, boy.
Oh, boy is right. All right, let's get into it. We've got Martin Pelletier of Trivest joining us, and we're going to talk about the markets, and we'll probably sprinkle in some politics if I know Martin. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Okay, Martin, thank you so much for joining us on the show. Where should we start? What are you hot on about these days? Should we start with tariffs before we get into anything else?
Maybe a good starting point would provide a 30,000-foot view of our philosophy and how that ties into some of the current events. Does that sound good?
Yeah, let's do it.
Yeah. So our investment philosophy and approach is very different than what you would have from many other managers out there. We do a pension plan approach, and so we call that goals-based investing. So we're not trying to beat the market. And what is the market? That's the problem. Is it the U.S. market that's doing really well? Is it the TSX? Is it Europe? Is it China? We really don't know what the market is. And so we really try and focus on generating a portfolio return based on a client's financial goals and objectives. Now, most of our clients are very well-to-do, entrepreneurs, sold their business, so they've taken a lot of risk in generating that wealth. So when it comes to retirement, they don't want to take the same kind of risk with their portfolios. They want to protect it and grow it a little bit. And so in many cases, getting a 6 to 8% annualized return after all fees, and given where inflation's at currently, that'll do the job, because if you compound that, they're not certainly spending those returns. And the numbers look very large when you run cash flows.
So that's good perspective, because then you're not going to be the guy to tell us about some speculative quantum play or to put what % of your portfolio in Bitcoin.
Actually, the opposite. And so it's important to have that context. It's not that we're adverse to risk. It's just a matter of it's just not what a lot of our clients are looking for. If we could do in the old days a ladder GIC strategy and get our clients 7% and then with full downside protection, we would do that all day long. You just can't do that in today's interest rate environment, even though rates are that much higher.
So you're trying to give people stability and really protect losses in the portfolio, not take these big swings. How do you do that in this environment? I mean, let's use tariffs as an example. It introduced a little bit of volatility. Now it seems like, okay, cool, we're going to get 1 month off of that. But it really exposed the vulnerability of the global sort of trading system and norm that we've all come to enjoy over the last, call it 50 years, and also some of the strategies that have taken place in Canada to really enforce our dependence on the U.S.
Well, I've got two answers to that. You've got the risk management from the geopolitical level within Canada, which I have been vocal on, and then they're also within your portfolios. The best way is through asset allocation, diversification, getting access to new markets and diversifying in different investments. And then also within portfolios, you can use derivatives. In regards to tariffs, the way I'm looking at it is my hockey analogy. We've had 2 years of back-to-back solid great gains in markets, global markets, not just the U.S. Canada did well last year and did well the year before. And so we're in the third period here, entering the third period with some pretty solid lead against the opposition. And now all of a sudden, you're having some serious threats in the form of global trade disruption and tariffs coming out of the U.S. And so now, as you mentioned, we have a 30-day reprieve or time to deploy some strategies to protect yourself. The way I'm looking at it is now's the time to be a little bit more defensive. In hockey, they call it playing the trap, playing the zone, and trying to stop the puck from going into your net. And so I'm hoping Canadians will appreciate that. And so now is not the time politically within Canada to get aggressive against an opponent that's very strong. It's time to be a little bit more defensive, and the same thing with your portfolio.
So how would you grade the Canadian approach so far? Let's start politically.
Very poor. We're going head to head against somebody that, we're a pimple in an elephant's butt if you take a look at it. The U.S. needs us we need the U.S. more than they need us. You just look at the impact on our GDP, the trade. 75% of our trade goes to the U.S. It's not that way in the U.S. into Canada, and so we have to be very careful. In my post column, I talked about being caught in a riptide, and if you're caught in a riptide, do you try and fight it, or do you try and swim to the shore and get out of that riptide? And I think that's the approach that we need to take. It doesn't mean that we need to roll over and take whatever's being given to us. No, we have to absolutely use this time strategically to ask ourselves how we got here to begin with, and how are we going to get out of this mess.
What do you think the best way forward is?
The best way forward is to get information, and the more information, the more facts. Facts are important. There's so much poor data and bad facts being spun out there as a narrative. I don't like narratives. I want facts, and reality is much different when you look at it. Like, I always ask myself, if someone who's in my body, would they see the same, would they view the reality the same way I view the reality? And so we really have to try and get ourselves in the Americans' point of view and the Trump point of view. And that's a scary place to go. But we really have to try and get an understanding of what do they want, and then position around that. And I'm not seeing that.
So do you think it's about much more than what has been discussed? It's just about border and fentanyl. There was this hint about protected industries, and, Trump called out the banking sector. Do you think that could be, the way that Canadian banks can go into the U.S., it's not reciprocated, right?
Again, putting ourselves in their shoes, it's more than just the borders. There's obviously more to it than that. And there are some, based on what I've been reading, there are some serious challenges that need to be dealt with, and that's fine. Is that going to get us over the hurdle rate? Probably not. So is it banking? Is it telecom? Is it oligopolies? I mean, in reality, would they want to come up here, right? It's just a tiny and market for them, and dispersed all across geographic regions. So from a profitability standpoint, I just don't see the attractiveness of a U.S. bank coming in here. So it's more to it than just that.
Okay, there's tariffs politically to consider, but then, as you mentioned, we've got our own political situation here. We're looking at a change, and I think, you're in Alberta. It's no secret, I think, how many in Alberta view Trudeau with respect to the energy sector. Does that view soften at all if it's Mark Carney, for example, who is starting to walk back on carbon taxes, for example?
No, and I've been vocal about it. Carney is going to impose policies, and I view him to be strategically more advanced than the existing government in power. And so they will impose climate change as a primary policy objective. And so this, if you back it up, if we had the ability to redirect 4 million barrels a day, which is 60% of U.S. exports, and then you had the Eric Nuttall on your show, and he'll do a much better job than me, and he did. But if you could redirect that oil that's being sold at a discount to international markets, all of a sudden we have a couple of pocket aces in our hand versus 3s and 6s and 7s, and we're going to lose the poker hand, and they know it. But it gives us much more strategic advantage. And we've been saying this, Albertans have been saying this for some time, that energy security is important. And we're selling all of our oil into the U.S., which happens to be also our biggest competitor, because as you've seen, they've been able to grow their production, albeit at a lighter end of the barrel. And so we need to look at ourselves strategically, and how we improve our negotiating positioning against the U.S. And we got here because of the policies of the last 10 years. And it's not just Trudeau. I mean, we didn't see any major pipelines built under the previous Conservative administration with Stephen Harper. And so we're here. And so the biggest thing is, where do we go from here? I mean, you had LNG facilities built from start to finish in the U.S. in 30 months. 30 months. And look at what happened with the TMX. So there's a lot of things that need to get done.
Some investors prefer to just tune out politics altogether. Is that your approach to investing? Like, I know you're vocal on politics, but do you kind of cancel that out when you're approaching investing? Or would you say we're in this era where it really does actually dent and affect the portfolio?
Absolutely. And so, for example, let's just say we get into a trade war. Carney gets in. Carney gets elected. Carney goes after with a production cap. We have tariffs on oil. I mean, that's not a good scenario for owning oil stocks in Canada at all.
What does that mean in terms of downside? Like, what could you imagine some of your downside risk is then?
Well, thankfully, we have OPEC doing a darn good job of keeping prices high, and we have high U.S. dollar, so that's providing some good downside protection. But I don't want to own a growthier segment of the market for downside. In, like, if I'm going to play a safer trade, like risk versus return, I'm going to own a Canadian bank over a Canadian oil stock with that kind of environment. There's just no growth in any of that. Sure, I can harvest the cash flow, but there's zero production growth. And then I get the downside of oil commodity. And you don't want to own commodities long-term in your portfolio. That's proven to be taking away returns and adding risk. And so you have to be strategic in your positioning.
So that's a double whammy of tariffs and potentially your view that a negative is that the Liberals remain in power. Let's flip it. What happens if we do ultimately satisfy the U.S. demands? We get a full reprieve on tariffs. And, as the polls indicate, the Conservatives come to power whenever there's an election.
There's a trade there, and we've positioned around that. We own some of these stocks, mid-cap stocks that are more exposed to tariffs, have really sold off fairly hard here. And we've been buying some of those on that potential of a trade. So there are some trading opportunities, absolutely, around that. But do I want to bet the farm on that scenario? Probably not. I would hope it would play out, but there still is, in let's just say the Conservatives get in power. Quebec came out the other day saying there's no social acceptability for pipelines at this point. Although taking a third of $1 trillion of oil money from Alberta. There is still a lot of dynamics playing out between the provinces that could impede growth, even if you had a change of government. And so that is still a risk. But there are a lot of trades you can do from now until then in that segment of the market.
Do you ever traffic in gold stocks?
You and I had a chat about this, I don't know if you remember, a while ago. And I got the call completely wrong on gold. And although I couldn't see, and I'm sure few others did see, the uncertainty around the Trump administration coming in and gold's response to tariffs. Gold, as I'm a fan of Ray Dalio, and gold should play a part of a portfolio from a diversification standpoint. I think it's a much safer and a better way to play a liquidity fed U.S. dollar protection and inflation and geopolitical uncertainty. Gold's a good way to play it rather than a crypto like a Bitcoin, which I view to be I call it levered beta, which is a 2 to 3 times big tech trade. So that's not going to do any good in these kind of uncertain markets.
All right. I do notice, I've noticed on your Twitter, you're no fan of these cryptocurrencies, or maybe the fervor around them.
As I mentioned, we're pension plan managers. That's the approach. And like I said, a lot of our clients took the risk and did very well, generated some amazing returns. The stories that I've seen. There was a fellow that I was on the board of, and when he was 60 years old, he started with $2 million, and through his businesses and investing, he managed to turn it into $150 million in 10 years, which is substantial. And
through crypto?
And so, not crypto.
Okay.
Operating businesses.
Oh, I see.
And so am I going to go to him and say, hey, you should be looking at these cryptos? No, he's going to want to protect that $150 million, and he's doing such. You look at private investments, all kinds of different types of owning direct land, those sorts of things. So there's much better ways to make money as an operator and they're not going to come to us to do that. So crypto, it should play a role in a portfolio. And Jurian Timmer, a excellent strategist at Fidelity, has done a good job of showing how like a Bitcoin should fit within a portfolio. Maybe it should have a somewhat of a role, but it certainly shouldn't command the kind of attention it does as a representation within a portfolio.
All right, we're going to take a quick break and dip into the mailbag. Okay, we are back with Martin Pelletier of Trivest. Our first question, actually our first and second question, is about Baytex. And I feel like there's something about Baytex Energy. Is there kind of a cult-like attraction or a group around Baytex Energy? Maybe first give us that backstory before I get into the questions, Martin.
Yeah, there's this whole sub-crowd within the oil community that has a select few names, and Baytex is one of them that seems to be getting a lot of attention. The way I look at that company in particular is as a trade. It was very similar to a company that we did play earlier called Tamarack Valley. And Tamarack, I think Tamarack's a much better company fundamentally than a Baytex, but very similar in regards to what's happening. You have large institutional selling, and the name just, no matter what it does operationally, just not getting a lot of love. When that selling is finished, there's a turnaround there, and so we made a lot of money on Tamarack Valley, even though it was painful for some time. It did fantastic last year, and we think the same kind of situation can play out this year. If you look at its Ranger acquisition, I mean it's trading below where it bought that company, and so there's not near-term trade, and so I'm not into that cult-like following. I like to watch it, but I'm in it for a trade.
Okay, so that was the question from Michael, and he actually referenced Eric Nuttall, longtime Baytex guy, admitted on the podcast that he had sold out just because it had become a frustrating stock, noting that there was that overhang, right? There was private equity involved that was just a constant seller of the stock, and that just outweighed the fundamentals, which he said were strong.
Yeah, and I'll jump in there. I have a different mandate than Eric. Eric's got to outperform the Capped Energy Index, and that's his benchmark. And so when you get something like Baytex that's just done so poorly for so long, that's going to impede your performance. And so you have to be able to outperform that particular index. We don't have a Capped Energy Index, or so I can take a position on something like that for 2 years or a year and a half, like Tamarack Valley, and then have the pop all of a sudden, and then sell it and make some good money.
So there's a follow-up question from Spud in Edmonton who wants to know if there are Baytex-focused structured notes that you can write to limit downside. Explain how you would use that, or would you use that?
So I'll back it up from a high level. So structured notes are just another risk management tool. We use it to replace our fixed income component of our portfolios, and maybe a hybrid of fixed income / equity. A structured note is just a vehicle. Think of it like a mutual fund or a trust. And it's a contractual obligation to a Canadian bank. And what they do is they do a number of trades within that structured note, option trades, on an index or stocks or whatever you want to do with a predefined outcome. And so what that does is it provides some embedded downside protection, and you get some upside. And that upside can vary significantly, monthly coupons or an auto call yearly, those sorts of things. Now, we tend to use structured notes on an index or on a group of stocks because we tend to get really good pricing, and it meets our mandate of our goals-based target returns and minimizing the risk. If there's a single stock, like a Baytex, for example, it's much better just to simply own the stock from the return versus the risk standpoint. It's taxed better because it's a capital gain, whereas structured notes are all taxed as income. And so when we're looking at individual stocks, much rather own the stock itself. And you can actually, if there's liquidity, maybe not on Baytex, but in CNQ or others, you can do options themselves, buy a put or do a call.
Generally, how are you thinking about your exposure to the energy sector?
So we have been reducing it. We have this window here. We had a rally, and we've been reducing it and de-risking. So what I mean by that is we're maintaining the exposure, but reducing the risk exposure. So more recently, we've locked in some substantial gains. Yes, we're triggering capital gains. It certainly is nice that the capital gains changes are not coming through until January of next year, assuming the government gets reelected. And so we've been selling some big positions, some big gains. Suncor has been a very big winner for us. CNQ's been a big winner. Trimming back Cenovus a little bit ahead of the tariff risk from the rally. And then we've sold those and bought a structured note on the Capped Energy Index, which is a lot of those same names, dominated by CNQ and Suncor, which are awesome names to own. But as an index, we wanted to add some downside exposure. So we sold those, locked in some. We're gonna have to pay tax, capital gains. It's not a bad thing. If you're paying tax, you're making money. And we did a note and a structured note on that index, so that in 12 months, if those group of companies are collectively above 0%, all they have to do is get above zero. If the note gets called away, we get a 20% coupon, a 20% return. All taxes income, but that's a pretty good return. And I'll finish it. It has 40% downside protection. So as long as it doesn't fall more than 40%, we get all our money back on those notes.
And we're going to talk a lot more about that in Pro Pick, so stick around for that. Let's move on to our second question. Well, I guess our third question, since we had two on Baytex. This one is totally jumping out of the energy sector and into big tech. This one coming from a fan of the show, Arnie. What does a U.S. trade war with China mean for stocks like Apple and Tesla?
Not good. And you know what's really interesting is that on the Monday, the days are becoming a blur because it's very bipolar. There's big moves, and it was quite negative. And so, like days that we saw the sell-off, Canadian energy was only, like the Capped Energy Index was only off 0.5%, but names like Tesla and Apple were off 5, 6, 7%. So it's telling you that there's some risk there. And when I look at the big tech, people have been buying the dips, and it's been working out. It's been 2 back-to-back years. But you have a high level of concentration in the S&P. You have 10% of the largest U.S. stocks now reflecting a record 75% of the U.S. equity market, and that's above 73% of the .com. So there's a lot of risk there that are exposed to tariffs. Apple, 56% of its sales come from outside the U.S. At the same time, its revenue growth has been flat since September 2021. So no revenue growth since September 2021, and the share price is up 60%. 10 times sales, 40 times earnings. Tesla, its share price is up 63% last year. Do you want to grow its revenue by last year? 1%.
I know, and I've made that point too on Tesla. It seems like where is that premium coming from? And it seems like it's just because of Musk's closeness to Trump.
Well, you think there's a cult following on Baytex. Look at Tesla.
So much smaller.
It's crazy. And so that's where you asked me earlier, don't let your politics into your investment decision. Well, in certain cases, you have to look at the big picture macro. But, you know, if you're a mega fan or a Trumper and you have to own Tesla and Trump's doing wonderful things and Tesla's that, and like that's not a good way of investing. By the way, Tesla has 61% of its sales outside the U.S.
Outside the U.S. Yeah, no, China's such an important market.
Yeah. So sure, they have plants in those regions. Okay, there's all kinds of excuses, but there's risk there. I mean, look at what happened on the day. So if tariffs get worse, those stocks are going lower.
So here's my pushback to that, particularly on Apple. During the entire first presidency of Donald Trump, the stock did fine over those 4 years, more than fine. And in fact, let's say from like 2017, when Trump actually took office, to today, Apple shares are up more than 660%.
Yeah.
And that's just a rough estimate. And Apple, particularly under Tim Cook, did such a remarkable job at navigating those tariffs the first time around. And those tariffs were still, they did not soften under the Biden administration. They intensified. The rancor was still there between the US and China. So my pushback is maybe Apple is just really good at navigating through all of that.
Let's take a step back. So valuations, okay? If you bought there was a great chart by JP Morgan Asset Management. If you bought, and it went back 27 years, plotted each month, if you bought it based on a PE multiple, what the 10-year return was following. And there's a linear regression. You can see there's a high level of correlation. Where we are today in the S&P is if you bought it today, the forward return has been plus or minus 2% over 10 years. It doesn't mean it's going to be plus or minus 2 average. It means it's going to be a wall up there. And so I'll give you the example about Apple. And yes, they've done some good things. Yes, it's a solid company, although they have been able to grow their revenue, as I had mentioned. We're seeing a multiple expansion. So when you look at good old-fashioned, when you're investing in a company, now people are taking pictures on Twitter or X, throwing Benjamin Graham's book in the garbage. Well, intrinsic value is you buy a company today, you get the sum of the free cash flow growth, and you sell it at the end of the judgment day and at the multiple that you're going to get. And then that's your rate of return. If you did Microsoft in 1999, outstanding company, I love Microsoft, and we own it. If you bought it in 1999, it grew its free cash flow through to 2012 by 300%, like some really good numbers, but you lost 50% of your money as an investment. The reason being is there was a huge multiple compression from 1999 to 2012. It went from 10 times sales and it fell by half. But if you bought it in 2012, the free cash flow growth to now, it hasn't been the same as it was that prior period, but you made a lot, like 12, 13 times your money because you bought it at such a low multiple. So that's all I'm saying is look at the multiple you're paying today, okay? Unless it's a trade. If it's a Baytex trade and you're going to be in for a year and you're trying to play whatever it is you're trying to play, you're a hedge fund manager, that's not the business we're in. With the exception of energy, because I was an energy analyst, I could pick away some trades there. I'm not a tech analyst. It's not my sandbox. And so that's the approach that we're taking with an Apple is what's the multiple going to be in 10 years? Yes, they can do wonderful things with free cash flow, although they're not more recently, and there are some near-term threats. Is that in the multiples? Now, if Apple sells off 20 and 30%, and there's a tariff war, and that multiple compresses, that's a different story.
Well, I'm wondering if we're actually seeing that play out in one of your holdings. You said you own Microsoft, and everybody knows Microsoft is a magnificent seven, except in the last year, it hasn't, over 1 year, it's flat, hasn't done anything. And maybe that's because it's too expensive.
Yeah, it is expensive. Now, I should clarify, we don't own the stock directly. We own it through the S&P. Now, we're talking about risk management. We did a cover call put spread strategy on the S&P 500 last year. So what that did was it provided full downside protection and capped their upside. We got called away in the end of December, early January. At the end of December.
What does that mean when you say we got called away?
So we wrote a call on it. We were forced to sell the position. We didn't roll it at a 14% gain. And over 6-7 months, which was fantastic for us. And so we had to redeploy those funds, which is dominated by Microsoft, Apple, those sorts of names, NVIDIA. And so we didn't redeploy it. We bought value. We bought US value, which has been the better trade because you're not getting the tariff exposure.
All right. And again, we'll talk about that more in Pro Picks. Let's get a question in from Karabar on X. Wants to know why the Amplified Junior Silver Miners ETF, ticker SILJ in New York, is lagging. We talked about gold, and you said it has a role in your portfolio. The gold miners are outperforming bullion. What's your view on silver?
So we don't play the individual commodity stocks. We do own commodities, absolutely, direct commodities. And we use a manager here in Calgary that's done a good job on that. They have a model that's based on equal weighting commodities. They actually include Bitcoin as in there as commodity, which I like. And so we do own the commodities. Now, when I was an energy analyst, often we would look at what oil companies traded versus the oil price. And you could buy the oil price indirectly through the companies. And so sometimes the companies reflect a lower oil price, which I'm sure Eric Nutter will tell you that they are currently, a substantially lower price. Sometimes we reflect a higher oil price. And so what hedge fund managers in the old days, I'm not sure if they're doing that now, they would go long the commodity and short the producers or vice versa. And so if there's that situation playing out in the producers, is telling you that investors in the stocks don't believe in the sustainability of the commodity price. You can make the call. If you think that commodity price is going to stay there or go move higher, then the better trade is for the producer. Don't want to maybe short the commodity, but there are ways to do that. But that's the way I look at producers versus the underlying commodity.
All right, let's take a quick break. We've got some macro questions next. And we're back with Martin Pelletier. This question is about the Canadian dollar. It comes from Alan. Will a lower Canadian dollar make Canadian equities more desirable? And with potential change in government later this year, can the TSX expect more growth? If so, what sectors, stocks are you keeping an eye on?
Okay, excellent question. The problem is that a low Canadian dollar makes us rely on our low productivity. It offsets that. I like seeing a higher Canadian dollar because it forces us to compete against the U.S., which is kicking our butt on a productivity standpoint. So we don't want to rely on that. The second point is the stock market does not always follow the economy. And that's an important distinction as well, too, because I think the Canadian economy is going to do quite poorly, certainly compared to the U.S., but I think the Canadian stocks may do better than U.S. stocks. Simply because of the valuation disconnect. I'm hard to find. I don't know if you can find a Canadian company trading at 10 times sales. But tell me if you can find a company. Which,
by the way, is a lot.
Yeah.
10 times earnings, no. 10 times sales, that's a lot.
Well, anyway, so Sun Microsystems back in the day talked about, there's a great quote about 10 times sales. You can look it up, ask ChatGPT. Now, on the currency itself, we've been buying the Canadian dollar, buying US dollars when the Canadian dollar gets above 70 cents. I'll reference it from the Canadian standpoint because that's where we're at. If it falls lower, 66, 65 cents, that's when we would be a buyer of it. We think Canadian stocks are poised to outperform. The sectors that we like are pipes, utilities, infrastructure, lifecos. Banks are a little bit we're not buying now, but should they sell off, and as you had mentioned earlier about the threats maybe from U.S. banks coming in, I don't think that is a legitimate threat, but if it does sell off, we'll be a buyer of banks.
Now, you just made me go down this rabbit hole about 10 times sales. It was Sun Microsystems co-founder and former CEO Scott McNeely who had a famous quote about 10 times revenue. At 10 times revenue, it gives you a 10-year payback. I have to pay you 100% of revenues for 10 straight years in dividends, basically saying, what were you thinking? Do you realize how ridiculous those basic assumptions are?
Yeah, and there's no income taxes paid. You're assuming no income taxes, no operating costs. It's crazy. And so can you extrapolate the growth? So yes, that this AI revolution is real. It's happening. It's exciting. But is that reflected in the current multiples? A year ago it wasn't. 2 years ago it wasn't. Maybe it isn't today. But if you get the call wrong and you buy it at the wrong time, again, Timmer from Fidelity, he has this great thing about dollar cost averaging. Everyone says if you dollar cost average, you'll be okay. But he gave specific examples in time that even if you dollar cost average and you got the timing wrong, you did bad. And so our clients, they generated all of this wealth through selling their businesses or whatever the case may be. And let's say I get bad luck and I don't get that multiple timing right, and it sells off and they lose 30% of their wealth. I'm out of a job.
And just explain quickly for those who might not be familiar, the strategy of dollar cost averaging.
Sorry, good point. So dollar cost averaging is as a young person, and we do these sessions with our clients' kids and grandkids. It's a great strategy as a young person averaging into the market. So we call it pay yourself first. So you do your budget, and if there's anything, you want to have something left over, and you're going to need help from mom and dad these days because housing costs, everything else, and grocery costs are so expensive. But if you can manage to save, let's say, $1,000 or $500 a month, and you're using that to buy a house, you can average into the market over time. And so you'll take advantage of when the market's correct, and then over time, you're better off than trying to time the market, because if you try to time the market over the last 2 years, you would have lost out, and you would have missed out on some nice gains.
Speaking of housing, this question is from Sarah in Edmonton, and she wants to know how might U.S. tariffs affect Canadian mortgage rates? And it might seem unrelated, but central bank policy may have to react to tariffs in the form of rate cuts, and so that's how it could show up.
Yeah, and so we have to be, that's a really tough one, because yes, there will be rate cuts, but you can't diverge too far from the Fed, because the Fed is not cutting, and there's expected to be maybe 2 cuts this year. We'll see. There's a divergence of opinions on that. But let's just say the Fed is holding pat, maybe 1 cut. Canada does 5. Our currency gets walloped. And so they have to manage the currency against the economy. And if our currency gets hit, all of a sudden we import a lot from the U.S. And now you got, and if we slam tariffs on ourselves like Ontario wants to do, and the dollar's lower, the cost of living goes that much higher for Canadians. And so that impacts the 5 and 10 year curve. So there's something called interest rate parity. So what that means is that currency differences between regions have to match interest rate differences between regions. Because if there's a higher rate in another region, everyone's going to want to go there. So the currencies are going to have to adjust for that, and it'll be arbitraged out. And so make a long story short, I do think that oil will provide a backstop to our dollar, and that will provide some wiggle room for the Bank of Canada to lower interest rates. I think that the 5-year yields will come down a little bit. There is risk that if we get a Carney government and they continue running massive deficits, or they do a stimulus program, that they could flood the longer-term bond market with debt. So that will keep yields higher. But I'm not seeing that as low probability. So I think, bottom line, rates will be lower for your guest or question, and good time to renew that mortgage.
All right, we're going to take a quick break and get into Martin's Pro Picks. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer. It offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Martin, you alluded to this one, but you sold Suncor. So normally we've got pro picks that are all buys. This one I like. You're talking about positions maybe you should look at taking profits. And the first one is selling Canadian and U.S. oil like Suncor. Talk to me about that strategy in isolation, because I know then you're doing something after the fact with proceeds.
We own, and also we sold some Occidental at a loss. We liked Occidental because of the backstop by Warren Buffett into the company. We sold our Suncor position and our capped energy index position. And what we did was we redeployed that into a note, a U.S. dollar denominated note, because we want to make sure we get continued access to the U.S. dollar. When the dollar rallied the other day to near 70 cents CAD, we converted a lot of Canadian dollars into CAD. It never gets to 70 cents, we'll do that. And then we did a U.S. dollar denominated note based on similar to the capped energy index, Canadian large cap producer. So we're kind of replacing the Suncor within that structured note.
So, but tell me, what is the view? Because if you're replacing it, why sell Suncor in the first place? What are the downside scenarios that you're trying to mitigate?
We got 40% downside protection now. I love that. I'm going to sleep at night. And if we get it wrong, okay, again, it's sort of like, what happens if we're right? And I don't want to be right in this scenario, and tariffs cause the energy markets to poop the bed, and then there's things are down. I mean, I've made a lot of money on these positions, a lot of money. We bought them when they were selling off during the COVID period of time. And,
oh, wow. So you've really held on for a while.
We've been riding it up and down, but we've done well last year and the year before. We've done really well on those names. We don't own the Baytex in a large size, and we're not worried about. I mean, that's been a trade, but our core positions have been C&Q and Suncor and the Capped Energy Index. It's been beautiful. It's been a wonderful trade for us. We're quite happy about that. So we're selling and making some money, and we got to pay some tax, but the tax rate's not going up, and so now we're just de-risking that, and so now we own those names again. We got 40% downside protection. And we got 20% upside, albeit as taxed as income, but 20% upside per year. If it doesn't get called away this year, it got called away the next year at 40%. So a 20% return for a pension-like portfolio is outstanding. And so that's why we did that trade. So I'm going to be able to sleep at night if things go wrong, and if they go right, I'm going to make 20% for our clients.
All right, so let's put that view, how you like to invest, into context with the second idea, strategy, let's call it, selling the S&P 500 and going into U.S. value-oriented stocks. What's the call there? What do you think might happen? Where does this trade benefit?
Again, to the downside. You saw what happened to Apple and Tesla, and look at Google. I mean, I don't want to have that downside exposure. Now, keeping in mind, our portfolios didn't rocket like the S&P last year. We did really well. We met all of our goals on our targets. Our goal is to track from a balanced perspective, 80%, 90% of the upside, and protect 60% of the downside. So if that's our goal and objective, then with the S&P, we owned it. We made a 15% return in 6-7 months. Really happy about that. Do we want to buy it again at these multiples given the risks? The multiples haven't changed that much, but the risks, potential risks like tariffs, are that much higher. So if the multiples were reflecting those risks, then yes, we would have rolled it back into it. Now, if you look at the gap between the S&P versus value names like Berkshire Hathaway, JP Morgan, Broadcom, those which are in a Vanguard value ETF that we bought, there's a big gap there. And so we want to own those names, because if those names are trading at a substantial discount to the tech names that are exposed to the tariff risks.
And that value ETF is ticker VTV. That's always been such a debate, though. Is growth over? Is it back to the value trade? Do you really think that this is the year?
No, I told you at the very beginning of this interview, we're playing the trap. We're playing defensive. So we weren't trying to make that call 2 years ago. We're just looking at multiples versus risks, and there's substantial risks. And this is a safer trade. It's a defensive trade. We're locking in some good gains for the last 2 years, 2 periods, going into the third period with a safer trade. If we get 6-7%, we're happy about that.
It is a Canadian podcast, so we're nothing if we don't have at least one hockey analogy. So thank you for bringing that to us. Your third one is on the U.S. dollar. Buy U.S. dollar anytime the CAD, the Canadian dollar, is close to 70 cents U.S. Right now, where is it? Is it around that level?
I haven't looked this morning. Where are we at?
Yeah, 69. So you would wait until it hits a full 70?
I'd still do anywhere from 69 to 70 if you're underweight U.S. dollars.
And then what's the call there? Why are you doing that?
Again, defense. Let's just say the energy complex rolls over and there's no support for the dollar. The Bank of Canada has to cut more than the Federal Reserve. The dollar is going lower. And I mean, it's not going to, like, I've seen calls with a 5 handle. I mean, this.
On the Canadian dollar, to be clear.
Yeah, the Canadian dollar being, 55, 60 cents. That's just not happening. Although I'd like to say it is just to scare people away from voting from Carney. But it's not. That's not going to happen in reality.
Even if Carney gets in, let's get you on the record on that.
I mean, he was a former governor, so he's got a close eye on that dollar and interest rates, and he's a smart guy. I mean, he's one of the smartest people, in the room, and that's also dangerous. So if he gets in and he imposes a climate change policy and putting climate change tariffs on imports and slams it with a production cap on energy, and OPEC decides Russia gets a peace agreement with Ukraine, they hit the market with oil, oil and OPEC can't control prices, oil prices go lower, yeah, we could see a 65, 60 cent dollar. I mean, all of those things have to come together.
But that's not your base case.
No. I'd be a buyer of Canadian dollar if it goes to 65 cents. I'd be converting. We have like 45, 50% of our total portfolios in US dollar denominated assets. It's been fantastic for us. Last year it was up 8%.
But it sounds like you wouldn't shift even more to the US dollar denominated assets right
Just
now.
on that reprieve here, like when we're getting this 30 days, and if it goes to 70 cents, then 70 cents isn't reflecting the risks of the tariff threats. And you know, there isn't going to be a huge move either direction, but that allows us to do some interesting things. As I mentioned about the value ETF, we did an option strategy in the Russell 2000 because people are so bullish on U.S. equities. We fully put protected downside, all the downside on owning the Russell 2000.
Small caps.
15, yeah, and so from now until November, we have no downside risk and capped 15% upside risk. And so we had to do that in U.S. dollars. So it's a great trade. And who wouldn't want to own U.S. stocks? I know it's not tech, with 0 to 15% payoff profile. I mean, that's a no-brainer.
It's a no-brainer. Thank you so much. You've offered a lot of insights in this show, Martin. Thanks so much for being our guest.
You betcha. Thanks for having me, and try and get that puck in the net.
Thanks so much to Martin Pelletier for being our guest for the last hour. Don't miss our next show. It is all about crypto. We've got Matt Hogan of Bitwise joining us. We're going to talk about crypto ETFs, the cryptos themselves, maybe the exchanges as well. And I'm sure you want to know, what is the future of crypto? So get your questions in. You can find us anywhere on social media at In the Money Pod. You can send us an email to questions@inthemoneypod.com or submit them through our website, www.inthemoneypod.com. And if you're enjoying the pod, please give us a like, give us a thumbs up, subscribe. It means so much to us. We will catch you on the next episode of In the Money.